Today, I want to talk about one of the most generous and probably most misunderstood moves in Canadian real estate, co-signing, co-signing for a mortgage. Maybe it's your son or your daughter trying to break into the market. Maybe it's a sibling rebuilding after a rough stretch, and you've been asked to lend your name and your income to their application. Most people say yes without fully understanding what they're actually signing up for, how it affects their own financial future, and here's the part almost nobody knows, how they eventually come off of the mortgage. So whether you're a parent being asked to co-sign for your kids or a buyer wondering if adding mom or dad to the application will finally get you approved, stick around because this episode is going to walk you through exactly what co-signing means, when it actually helps, and when it doesn't, and the exit strategy most people don't know even exists. Let's begin. Okay, let me clear up the biggest misconception right off the top. Most people think of co-signing as a kind of character reference with a signature. You're vouching for someone, helping them over the line, and if everything goes to plan, it never really touches you. Most people are thinking, I'm just helping them qualify. They're the ones making the payments, so this doesn't really affect me, and so on. That kind of mindset. It's a completely reasonable assumption, but it's not correct. It's not accurate. When you co-sign for a mortgage, you are not guaranteeing a piece of it. You are fully responsible for the entire mortgage, every dollar, every payment. And that mortgage lives on your credit report until the day you're formally removed from it. So let that sink in for a second before we move any further here. The lender doesn't see you as a backup plan. Many people think. They see you as a borrower. If a payment is missed, it's your credit that takes the hit right alongside the primary applicants. If the mortgage goes sideways, the lender can pursue you for the full amount, not your share of the full amount. And here's the ripple effect that catches people off guard, because that mortgage now reports on your credit bureau. It counts against your debt ratios going forward. So when you go to buy your next vehicle, refinance your own home, or purchase that rental property you've been eyeing, that co-sign mortgage payment is factored into your qualification as if it were your own. Because in the lender's eyes, it is your own. Your purchasing power shrinks the moment you sign, and it stays shrunk until you come off the file. So co-signing is a genuine act of generosity. It's typically offered amongst family members. The intention is always genuine, but be aware that it's a loan of your financial capacity, not just your name. Now, I don't mean to sound like a big warning label, so let me balance it out a bit here because it certainly deserves balancing. In the vast majority of files I work on, co-signing arrangements end positively, and everyone at the table comes out ahead. The buyers get into the market years earlier than they could have alone. The co-signer comes off the file on schedule, and the family builds equity along the way. And here's how I handle it in my own practice. On every application involving a co-signer, I dedicate a personal confidential call with the co-signer where we walk through the file in detail and, just as importantly, a specific exit strategy. The phrase I often use on those calls is that they're being borrowed for the mortgage application, because that's exactly what it is, a temporary loan of your financial credibility and your strength with an opportunity to exit at any time, provided the main applicants can qualify on their own down the road. Okay, so now here's the part that surprises people on the other side of the table, the buyers doing the asking. A lot of applicants assume that adding a co-signer automatically strengthens the file. Okay, so, dad earns good money, so let's add dad, and boom, approved. But that's not how the math works. When a cosigner joins an application, the lender doesn't just add their income, they add their entire financial picture. That's their income and their debts, their car payment, their line of credit, their own mortgage, property tax, and heat. All of it gets worked into now what's becoming the combined application. So the question isn't how much does the cosigner earn? The question is how much room does the cosigner actually have left over? And let me give you a quick illustration here. A cosigner A earns $150,000 a year. Sounds like a slam dunk, but they carry a $1,100 a month truck payment, let's say a $500 a month line of credit payment, and their own $2,600 a month mortgage payment. Okay. Now let's look at cosigner B. They earn $85,000 a year. So quite a bit less than the 150, but their home is paid off and they're debt free. So everyone would assume that cosigner A would be the front runner here just because of their higher income, but that's not the case. Cosigner B ends up being way more impactful on this particular example, as they don't have debt payments, which are definitely factored into the mortgage application. In my experience, the files where a cosigner truly moves the needle are the ones where the cosigner's own balance sheet is clean. Strong income relative to their obligations, solid credit, and room to spare. So before you assume a cosigner is the fix, have a broker run the combined numbers. Sometimes the cosigner you have in mind adds absolutely nothing, and occasionally they can actually make the file worse. Okay. Now for the good news. I have some good news. When you're co-signing, and that is the part almost nobody knows walking in. Many co-signers assume that once they sign, they're married to that mortgage for the entire life, 25, 30 years of obligation, whatever the amortization is. That's not true. Here's the reality. As soon as the primary applicants can verify that they qualify on their own, their income has grown, their debts have come down, their credit has strengthened, hopefully over time. The cosigner can be removed from the mortgage. The lender re-underwrites the file with just the primary applicants, and if the numbers work, you come off. It's as easy as that. This could happen like 2 weeks after you close the initial mortgage, or 2 years, or 10 years. It doesn't matter. The primary applicants have to pass the qualification math on their own, including the stress test. But once they do, the door is open. And here's my personal recommendation, something I tell every family I work with on these files. Build the exit into the plan from day one, like diarize it. Revisit the numbers every year. Renewal time is a natural checkpoint for many people. Incomes will rise, debts will get paid down, and in many cases, the primary applicants can stand on their own 2 feet years earlier than anyone expected. But nobody at the lender, with the lender or the bank, is going to call and offer to remove you. So you have to initiate it on your own. So make the annual check-in part of the deal you strike as a family. One practical note as well here, removing a cosigner involves some paperwork, a lender approval, and legal work to update the ownership registration will be required. There's some cost involved, but it's modest relative to getting your full borrowing capacity back. You're looking at a legal fee anywhere from $800, I'd say, to $2,000, depending on where you live and the size of the property and the mortgage. Okay, before we wrap up, here's one more thing worth mentioning. There's a shift in the industry regarding cosigner and guarantor policies that you need to be aware of. There used to commonly be 2 ways that you can, come on an application to give it a boost. Number one, the guarantor, who guaranteed the debt but wasn't registered as an owner of the property, meaning they would not be registered on title. And number two, the cosigner, that the term we're all familiar with, who guarantees the debt but also goes on title as a legal owner. For years, the guarantor route was the preferred way, and for obvious reasons, as it was a lighter touch point option. You would boost the application, but you forego registering on title and having the mortgage listed in your credit report, thereby technically leaving your purchasing power unaffected. So the whole cosigner option is still around, but it's also kind of winding down. More and more lenders, almost all of them at this point, have steered away from guarantor arrangements and now make it a concrete condition that cosigners register on title as co-owners of the property. And as a result, the mortgage also may get listed in their credit reports. Even if it's a 1% ownership interest, you're still on title. So why does that matter? A few reasons. Being on title makes your obligation crystal clear, like you're an owner and a borrower, full stop. It also means that eventual removal involves a title transfer, which is where those legal costs come in. And owning even a sliver of a property that isn't your principal residence can have tax implications down the road. That's a conversation to have with your accountant before you sign, definitely not after. But here's a useful lever that a lot of people don't know about. In British Columbia, when co-owners register as tenants in common, you're able to declare your percentage of ownership right on title. You can allocate your share of the asset to whatever you desire, anywhere from 1% to 99%. And I looked into this for Alberta as well. Same deal. Alberta's land title system lets you register unequal, undivided shares stated right on the certificate of title. For example, one owner as to an undivided 1% share, and the other can be 99%. One thing to note in Alberta, if the shares aren't specified, the law presumes them to be equal. I think this is with BC as well. So if you intend to do this, specify. Registering the cosigner at a nominal share like 1% can help mitigate those potential tax and estate planning consequences we just talked about. A smaller slice of property that isn't your principal residence means a smaller exposure. And as always, structure it with your lawyer and accountant at the table. So with all that said, none of this should really scare you off about co-signing. It's just the modern reality of co-signing. Assume you're going on title and be aware that the mortgage could also likely appear in your credit report too, and plan accordingly. So here's the bottom line. Co-signing can be the single move that gets someone across the finish line and into the market. But go in with your eyes open. You're on the hook for all of it, just like the primary applicants. Your own borrowing power takes a hit while you're on the file. And not every cosigner actually helps the application. Most importantly, remember, there's a way out. Build the exit strategy in from day one and revisit it every year. So if you've been asked to cosign, or you're wondering whether a cosigner is the right fix for your own approval, don't hesitate to reach out to me and we can have a deeper conversation. Okay, that's all I got for today. Call or text me anytime to discuss this episode or others in greater detail, especially if you're in British Columbia or Alberta, as I am licensed to service these specific provinces. Call or text me at 604-800-9593, or you can get me on WhatsApp, or just go ahead and link up to my website, homefinancingsolutions.ca, where you'll find my complete catalog of past blogs and podcast episodes. And one more thing, check out my award-winning mortgage app. It's embedded somewhere in the notes or profile section from where you are listening to or viewing this. This thing is amazing. It comes equipped with tons of calculations, market interest rates, and every other thing you can imagine. It even enables you to do a snap pre-qualification on yourself. You got to check it out. Give it a try.